So what's going to happen to the economy in 2008? Well, the Bank of England has just cut interest rates by a quarter point, but the honest answer is not even the Bank of England knows what's really going to happen in 2008. There's more uncertainty about the economy next year than there has been for more than a decade. And we enter 2008, we enter really uncharted waters because we've had a prolonged spell of sustained growth and low inflation, but all of a sudden there's a risk to growth and there's a risk to inflation as well. The risks to inflation are very clear. We're talking about reducing interest rates. People are shouting for lower interest rates at a time when oil prices have been nudging $100 a barrel, and although they've fallen back a little bit recently, they're still around $90 per barrel. That's a big price backdrop against which to talk about lowering interest rates. At the same time, we've had accelerating food pressures, and there's also consistently strong demand still in the high street, which has enabled companies to pass on the price pressures in their supply chains. And so the Bank of England is really worried. It's really worried about the fact that inflation may not be dead. They may be cutting interest rates and it may come back to haunt them because they may need to raise them again in the future to quell inflationary pressures. So those are the concerns they've got on the one hand, but of course on the other, there's a fear about growth. Last week they decided the risks to growth were greater than the risks to inflation. I think that's true. The Institute of Directors had called for a quarter point interest rate reduction. We'd not called for more than that at present because we were mindful of the inflation risk as well. So basically the Bank of England was saying we're hedging our bets here. We're slightly more concerned at this stage about the risk to growth than the risk to inflation. And why are they worried about the risk to growth? Well, you've seen in the press lots of focus on the house prices and the housing market and how house prices are expected to fall back next year. Now, one's got to be careful here. We can get sustained month-on-month falls in prices for quite some time without it actually meaning that we've got house prices lower than they were this time last year. So we can cope with falls in prices for a few months, but what we don't want to see is a sustained downturn, something along the lines of that which we saw in the early 1990s. Then we've got a real problem because that not only erodes the housing market, it reduces mortgage equity release, but it also reduces the wealth factor and the confidence factor of consumers. And at the present time, the savings ratio is at nigh on a 40-year low. It doesn't take much for consumers to get much more cautious, and if they stop spending and start saving, then it doesn't mean there'll be a dramatic swing, but they only have to do it at a marginal level for it to be very significant for the economy next year. We've got weakness in the city as well, and the contribution of financial services to GDP growth next year. So there's some big concerns out there that it wouldn't take much to unsettle growth. And whilst the Bank of England clearly has an inflation target, not a growth target, it's very mindful of the fact that if economic growth prospects were really undermined, then they wouldn't have an inflationary problem, they'd have a deflationary problem. Because this economy is unbelievably sensitized at the present time. The savings ratio is low, employment has been high and growing for many, many years. Growth has gone on and on and on. Many people don't remember what a recession was. And so it wouldn't take much maybe to swing consumer confidence quite quickly, and that's what they're nervous about. Thankfully, I think we can avoid those more gloom-laden scenarios there. We can be reasonably confident at the present time that we're talking about a slowdown next year. We're not yet talking about the R word. But the danger is there, and that danger was acknowledged by the Bank of England in reducing interest rates. But there's also another scenario, actually, where we get stuck somewhere in between. We get low growth and we get reasonably sticky inflation as well. In other words, the Bank of England can't cut interest rates far enough to kickstart growth again because inflation is just a little bit sticky. It won't get down. And that's probably where we're going to be. We'll see maybe a further interest rate reduction in the new year, but then it's quite likely that the pressure for reducing interest rates will still be there from a growth perspective, but there'll still be a block on it from an inflation perspective. And that's what we've got to be concerned about next year, that we end up with a situation of maybe 1.5% to 2% growth over the coming years because inflation's sticky and we can't do much about it. At the end of the day, That's not a disaster, but it's certainly going to feel very, very different to the performance of recent years. All bets are off, though, of course, if the liquidity crisis in financial markets turns into a real credit crunch, whereby banks really start curtailing their lending to consumers and companies. If that happens, then the R word does come back on the table. Maybe not immediately, but it's certainly something that the Bank of England will be very fearful of. So I've gone through maybe 2 or 3 scenarios here for the UK economy in 2008. I can honestly say I'm very uncertain as to between all 3 of them. I still think the slowdown and avoiding recession is the most likely prospect. But for the first time in 15 years, the R word is nearly, I say nearly, back on the table.